broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone. This is Chris. It's Tuesday, October the 2nd. Hard to believe, but officially summer supposedly over, and welcome to a beautiful time of year, the fall. Let's go ahead and get started. And just as a reminder, we want to be your 30-second solution to share chart patterns and help you make empowered decisions within just a few seconds, where you can see the pattern at hand, and also from a risk management perspective where the stop would be in case the position is wrong. Just as a reminder, we're not bullish or bearish. I don't ever want to see the markets or the economy struggle, but we'll just take what we get and try to take advantage of the price patterns that we have at hand. I'm always completely open-minded to however the price patterns start unfolding. I'm always amused when somebody says, "Oh, the market is not behaving," and I don't think there's such a thing as the market behaving. If you ever hear somebody saying that the market's not behaving, that's just a coded message for they have a bunch of investments that are going against them. So I'm going to stick with the theme of the good, the bad, the ugly that we've been doing the last few months, because there continues to be a myriad of different things that can fall under each of the categories. We're seeing a little bit of a shift of late, moving from the good to the indifferent in the middle of the category, or potentially some cracks starting to show up. We'll cover that in the webinar. But let's go ahead and just get started with the good. And the good is from a bullish trend perspective. This is a global snapshot of stock markets around the world. If you want to review this later, or when you're looking to what the heck asset is this that Chris is highlighting, in the gray bar is always the contract that the chart is looking at. So the top row, this is the S&P on the left, the Dow in the middle, the NASDAQ in the upper right. Moving to the middle row, this is the Russell 2000, mid caps, and value line geometric. And then on the lower left, to get a little international flavor, this is Germany on the left, France in the middle, and London in the lower right. And so I just highlighted with these blue circles, you can see that the trend is up for all of these indices. They're all above long-term moving averages. Sometimes I think it's kind of a slippery word as far as if the trend is up and it's touching the underside of a rising channel, is that resistance? Ironically, it shouldn't be, because resistance comes more into play when you have a series of lower highs and it's pushing up against resistance. But whatever you want to label it, there are times that when major indices are at the top of long-term rising channels, sometimes they peak. So you can see that all of these are facing multi-decade channels at the same time. The bottom row is a little bit more of a divergence that's taking place. You see a series of lower highs that are taking place over the last few months in these international indices. And I'm well aware, unless you've been in a coma or sleeping under a rock, that the United States has been the place to be. If you have tried to model a portfolio and diversify around the world, the United States assets are doing okay, and then everything else around the world is probably, if you had some equal distribution of assets and allocations, it could easily, that the global exposure could have wiped out any of the gains that the S&P has made this year. So one of the things that Ross Perot, when he ran for president, he used to say, lift up the hood and look underneath. One of my favorite tools is to look at the advanced decline line to really see how things are going. So this is two different advanced decline lines, or two different time frame looks. The upper left is the weekly advanced decline line that strips out its common stocks only. So in the NYSE and the advanced decline line, there are some closed-end bond funds and different closed-end funds. So this advanced decline line in the upper left does strip it out. You can see up here in the upper right that the advanced decline line is very near all-time highs. So it does continue to send a bullish message to stocks. So far, we've not seen any glaring divergences taking place from the weekly view. So I try to put this support line here, since it's kissing the underside of a long-term rising channel. It would take a break of support at 1 to send just a short-term caution message to stocks. The best way to use the advanced decline line as far as weaknesses is typically if the market starts to turn weak or diverge ahead of time. That's been when stocks have really struggled. But I will say in 2007, there was not any key divergence taking place that warned people ahead of time. But you can see that it kissed the top of the channel, and once it broke support, it sold off, or the advanced decline line declined for a couple of years. So this is an important price point where it is, but there's no doubt that the trend is up. If we move to the right chart, the daily advanced decline line, now we're going to really take more of a microscopic view. You can see at the calendar at the bottom, this is just looking back over the last few months. But the daily advanced decline line did hit an all-time high in the month of August, towards the end of the month, and since then it's made a couple of lower highs. And then you'll notice there was a series of flat bottoms. Then as of today, the advanced decline line on a daily basis did surpass the lows of that was hit in the first part of September, just about 3 weeks ago. So the takeaway here that I notice is there is a small negative divergence. This is the first time that this has taken place in a while. It doesn't send a bearish message at that time. But why I say a negative divergence is, today I believe the Dow set an all-time high. The S&P is just a fraction from an all-time high. But you'll notice that we've seen a lower high advanced decline line. So 3 weeks isn't very long of a time period, but we are seeing a small divergence taking place in the AD line, and this is the first time we've seen this in many months. So I'm going to continue to stay with, I still think the most important price point happens to be the combo price of the emotional 2007 high and the 2009 low, as we've been sharing steadfastly every week in our reports, and also in each of the Connect webinars. This remains to me a highly influential price zone that when you look back, in my opinion, over the last 11 years, the most important emotional timeframes were the 2007 high and the financial crisis low. When you apply Fibonacci to that, the markets hit the 261 level earlier this year and stopped on a dime, and then began some choppy action. We have seen a rally over the last few months, and the S&P is attempting to break out. As of today, it was around 2.4% above the January highs. I still think, the trillion-dollar question is what totally constitutes a breakout. One of the things that took place, it's not on this chart, but this right in here that we're looking at was the 161 level. And if you could imagine a horizontal line here, the market broke above it for a few months and came back and tested what was old resistance as new support, and then it took off higher. And so, as I said in yesterday's sectors report, I think the ideal price action, everyone, for the S&P is it can break out to the upside and never look back, and there's not a darn thing wrong with that. But I think ideally, to test this resistance as support, the ideal price action would be for the S&P to actually rally up a little bit more. Ideally, it'd be nice if it could get up, 5, 6, 7% above the line, and then come back and actually touch the old line as new support and then push higher. So no matter how we look at it and how this pans out, this still is, in my opinion, an 800-pound resistance zone. And this is a place where the bulls don't want to see negative divergences taking place. They don't want to see selling pressure take place. They don't want to see more new lows start taking place than new highs, because then it starts making the Fibonacci breakout less likely to take place. So, one of the things, one of my favorite themes is the Joe Friday, and I don't know about all of you, but does it seem like, hey, the market's really moved up a lot, as the talking heads on TV, new highs, new highs, new highs. But this takes and looks at performance since the January highs. And so if you can see on the upper right, this isn't anything scientific, but it's several key indices. The S&P is up a whopping 2% since the January highs. The New York Stock Exchange, which is even then a broader indice than the S&P 500, is actually down 375. EFA is down almost 10. Emerging markets are down 18, and China FXI, the China ETF, is down 20, almost 22%. And so, to me, I thought it was interesting today that CNBC was talking about real estate in New York and how it's had several quarters of softness. And there was I think it was a $23-25 million place it was on sale. They knocked $8 million off the price point, but had a lot of, the bottom line of the story was that they were surprised that oftentimes New York City prices correlate with the stock market. And so the journalists seem to be puzzled. Why is the stock market at all-time highs? And this real estate's been struggling now for, I thought they said a couple of years. And so regardless, to me, this picture is more indicative of what's taking place, that, since the January highs, when you look at the broad market and around the world, there's a lot of softness taking place. So to really have made much money, you'd have to almost abandon asset allocation and be solely focused on the S&P and tech to have much to brag about this year after the January peak. This is the Dow. It's reached an all-time high today. This was made a little while before the market closed, but you can see that the Dow is attempting to break above its January highs, which is the 261 level, again based upon the 2007 high and 2009 low. So again, this is a really important make or break place. There's still seems to be little conviction up here on behalf of the bulls and the bears. The bulls are struggling to really just push it and attract more buyers and go above. And yet on the flip side, the bears just can't seem to get enough selling going to make this a representative high. And so that's why I tried to share right away in January when the markets were up here that, I just want to be patient. Don't be surprised that you're just going to see choppy actions for months to come, because when the 161 level was hit, the market didn't go anywhere for 20 months. I said it earlier this year. I didn't think we'd chop sideways for 20 months. I said it then. It's very humbly. It's nobody has a perfect crystal ball, and you know me well enough. I don't either. But it is interesting to see that we've just had a lot of choppy action and not a lot to brag about on a global scene. So quickly turning to tech, talking about emotional highs and lows. The two most important highs and lows for tech arguably were the 2000 high, which was a dot-com high, and then after a 90% decline, the 2003 lows. Well, if you apply Fibonacci to the 2000 high, 2003 low, you can see that the 161 level is being tested right now in the NASDAQ, as well as the Dow and the S&P testing its 261 level. So tech's been obviously really strong since the lows in 03. This is another big threshold for the markets to see what they can do at these price points. Again, the last thing that with a trend up that the bulls want to see is cracks and selling starting to take place at these key fib levels. So as I've shared for the last few months, I crossed out, from the good, the bad, the ugly, the bad. There really wasn't many bad things going on, but there was a few bad vibes taking place. So I kind of want to update you on some of the bad vibes. And a couple of the bad vibes, we've shared for several months now, is that in 2007, the canaries in the coal mine, or in other words, the indices that when a person looks back in perfect hindsight and you looked at, well, what gave a tip off before the market really stumbled? What was struggling before the market started heading south? And the two of the indices that really stick out are banks and home builders, home construction index. Now, I'll be the first to say history does not ever repeat itself exactly. And just because those two indices were downside leaders in 2007 doesn't mean that they're going to do it again. But I'm going to remain open-minded and try to empower and share with you. If we're just seeing some things, I at least want you to understand and see what is taking place. And so a few canaries in a coal mine potentially this is the monthly chart on RSP, which is the equal weight S&P 500. So remember, the S&P 500 that you normally see quoted on TV is cap weighted. In other words, if Apple or Google or the FANG stocks or some of the biggest companies in the world, excuse me, their price action influences the S&P more than the stocks at the lower end of the S&P 500. So I like keeping track of how RSP is doing. You know, every week in the global dashboard, we put in the RSP, which is equal weight cap weighted ratio, which is RSP SPY, and it's been heading south for what, a year and a half. It's now at the lowest levels since 2016. Historically, that's not very bullish when it happens, but it's also not something that you just ring the bell that that's all out bearish. You know, but historically, you do want to see that ratio going up, and it's been diverging for, like I said, over a year and a half. The one thing I notice here is just 1 month doesn't make a trend, but this is RSP. This is a monthly chart. So the blue highlighted oval is the month of September. And you can see that it tried to break above the previous highs, which took place in January. And you can see quite a reversal that did take place last month. And so this has a chance to be quite a negative candle pattern, or a bearish reversal pattern, bearish wick taking place at old highs, which, if we see some selling pressure in time, we'll look back and say, whoa, that was a double top. So is a double top proven? Absolutely not. But you know, I do believe that monthly chart patterns are more important than weekly, and weekly are more important than daily. So this is, to me, a really important monthly pattern that took place in the equal weighted RSP last month. So a couple bad vibes here, but we can't move it over into the ugly stage. As I was just speaking of canaries in a coal mine, so this is a busy chart, but let's just walk through this slowly. The top part is the Dow Jones Home Construction Index, and as you can see in the lower left, we're going back to essentially 2000. And then the bottom chart is the S&P 500. But for those of you that might not have been paying attention at the time, at the 2003 lows in the S&P, you'll notice that the home construction index was actually creating a series of higher lows while the S&P was creating a series of lower lows. And so this was a bullish divergence from this upside leader. So it definitely outproduced the S&P for several years to the upside. So this was a bullish divergence taking place. And then if you move the clock forward, you can see that it started creating a series of lower highs in mid-2005 through 2006 and 7, well in advance of what the S&P did. So you can see lower highs in the top and then higher highs in the bottom in the S&P. But it was an indicator of some trouble to come. So then, you know, the S&P falls 50% in the financial crisis. But you'll notice that while the S&P was making lower weekly lows here, another bullish divergence was taking place in the home construction index by creating a series of higher lows. So this was a positive message being sent ahead of the market moving up for several years. And so now turning the page to 2018, this is a divergence that's taking place in the home construction again, that you can see that it's been going now, or going down and diverging against the S&P since the first of the year. So will this be important like it was 2007? You know, it's important. I believe it's important enough to share it. Time's going to tell if it's really doing its divergence and leadership again. But I'll have to, you know, tip my hat that it was pretty right in 2000, the 2003 lows. It was right at the pre-financial crisis. It was also correct at the 2009 lows. So I just can't sit here and just push this aside. I feel it's important, to share with you. I didn't draw it in, but if you take the 2011 lows, the 2016 lows, the indice is actually breaking that support line. So to me, a cautious message is for sure being sent by the home construction index. Another index that was a leader to the upside and to the downside as well in 2007 was banks over the S&P. So this is the BKX, the bank index on the top, the S&P on the bottom. You can see a series of lower highs while the S&P continued to chug along and make a series of higher highs. So we had a bearish divergence taking place from the banks in 2007. We had banks fall roughly 90% in value, and then they've rallied over the last 9 years. They've almost reached the same level where they peaked in 2007 earlier this year. This looks to be a bearish descending triangle, similar to what took place in the 2007 highs. So again, we have a bearish divergence taking place by a key index that did the same in 2007. So are we going to see an exact repeat that banks are going to break down and the S&P will follow? Still too early to tell, but the key would be is if this horizontal support, which is the bottom of a potential bearish descending triangle, if that gives way, the measured move would suggest that banks fall at least 15% in value. And so if banks would continue to diverge and fall another 15%, I think they would have some form of an influence on the S&P 500. Another look at banks from a little different angle. This is the regional bank ETF KRE. And you can see in the green shaded rising channel, since the 2009 lows, KRE has been in a solid uptrend. And let me beat the table and say nothing of late has changed the solid uptrend. Now the ETF, did hit the top of the channel this past year, or during the 2018 calendar year, and there's a chance that KRE is creating a head and shoulders topping pattern. It definitely has diverged as well compared to the broad market, but this is a key support test at 1, which has the potential to be the neckline of a head and shoulders topping pattern. So again, a key support test is taking place in a key industry where a divergence has been taking place for about 9 months. If it would break support here, the measured move would suggest that KRE falls at least 10% in value. So again, 2 key tests are taking place in the major and regional banks at this time. Another bank that I continue to share in our weekly reports is JP Morgan. JP Morgan has been one of the stronger banks over the last several years. As a lot of banks have diverged this year, JP Morgan can say that it has been successful in not diverging like the other banks have. But we applied, similar to the S&P and the Dow, we applied Fibonacci extension levels to the 2007 high here, the 2009 low. And JP Morgan also hit its 261 level earlier this year. This is a monthly chart, and you can see that it's chopped sideways. So this is a current chart. So here is last month, and I apologize, it's kind of small, but you can see that that's it attempted to break out, almost go to the highest price point of the year, and then it reversed on a monthly pattern and created a bearish reversal pattern just below the highs of this year. So there's a chance a double top is in, but continue to watch JPM. I have a buy alert on JP Morgan. If it breaks out to the upside, I'd be very interested in owning this quality bank. On the flip side, if JPM would continue weak, it would definitely send a caution message after last month's monthly bearish reversal pattern at the 261 fib level. Folks, I don't know why these things take place, but twice a year I share with you that around the first day of spring, which is March 21st, and the first day of fall, which is 9/21, that over time there's been some really crazy turning points take place around the first day of spring and fall. And so this is a look at the S&P 500. I don't know why, but what's two of the greatest buying opportunities in the last 17 years? They both took place near the first day of spring in March of 2003 and 09. And when was the best times, two of the better times in the last 18 years to do some harvesting, pull some risk off the table? And they happen to be around 9/21 of 2000 and 2007, because you can see that the peaks, there was a second high, a nominal new high in 2000, as relative momentum was creating lower highs, and that high took place, about 20 days before the first day of fall. And then you'll see in 2007 that it took place, roughly 20 days after the first day of fall on 10/12, where there was another nominal new high as monthly momentum was falling. So this year we have a nominal new high taking place in the S&P, with weekly momentum so far diverging and creating a lower high. So this is a price point where the long-term trending, your slow money assets, your 401k assets that you can't move often, you want to really pay attention to what the market's doing up here at these Fibonacci extension levels, because if you've made some really good gains over the last couple of years, this is a price point where one's going to want to consider maybe being happy with the crop that you have and do some harvesting. Another reminder of the junk bond divergence that's taking place. We've shared this chart a few times, but junk bonds diverged for almost 2 full years in when the market peaked in 2000. There was a 7-month divergence at the 2007 high, and we have almost a year-long divergence taking place currently in junk bonds in 2018. So if junk bonds would continue to sell south and we'd see some more cracks in the sand, this is another divergence that is not in and of itself bearish, but in time these divergences have led to the S&P at a minimum struggling to make much quality gains going forward. So as we lift up the underneath, this is from T.O. from the atlasinvestor.com, and this is just kind of looking where we are of the number of new highs versus new lows. So this would be a divergence taking place, as you can see, as the S&P is in the upper right at new highs, or just fractionally from new highs. You can see there are less new highs and more new lows taking place. And so there's some cracks taking place underneath the market. Another way to look at it is the number of new stocks that are hitting new lows, forgetting the new highs. You can see that even though the market is edging higher, there are a higher number of stocks hitting new lows down here in the lower right. And typically the new lows expand when the market is heading south, not when it's moving forward. So these last two charts are small divergences that are taking place in the market of late. Just zooming in real quickly, we just talked about junk bonds. This is a look at JNK. The other chart we looked at was PIMCO's high yield junk bond fund, and its symbol was PHDAX. I've been watching that fund closely now since the mid-90s. JNK doesn't have that kind of history, so you can't really chart that far back. But from a popularity perspective, a lot more people know now of JNK. And so there's been a little counter trend move. The long-term trend is down. There's a long-term moving average that's coming into play. So you see that there's triple overhead resistance. What the bulls would love to see, is that the Dow, the S&P, and the NASDAQ all break above Fibonacci extension levels, and junk do the same thing at 1. Bulls would get a cautionary message if you see selling start taking place at all those extension levels and junk bonds break down. So another key price point. You can see this is a weekly chart that there hasn't been much net action. So there's, folks, there's not tons of conviction by the bulls or bears in these trading ranges for quite a while. That's going to come to an end, and when it does, the longer that it trades sideways, the bigger the move, just like in 2014-15 when it traded sideways for 20 months. Once it broke out, the S&P made a 50% gain in about 12 months. So don't ever be bothered by sideways trading ranges, because they end up being your friend. And the longer that you're patient with them, the bigger the friend they're going to be to you. So what would take place as far as some things being ugly if they would continue? This is the Russell looking back over the last 7 years, very quality rising channel. This is a weekly chart. It hit the top of that channel a few weeks ago, and now we're seeing for the first time for most of the year, small caps have been an upside leader, reflecting relative strength against the broad market. Now we're seeing some relative weakness the last few weeks by small caps, and they're breaking about a 1-year rising support line at the top of the channel at 2 this week. So if we see continuing selling, I think, like, it's intriguing if you weren't paying attention to the market today and you saw, oh, the Dow's up, what was it, everybody, 100 and some points. Well, then it was a good day in the market. Well, then it's interesting that if you go look at the S&P, well, it was essentially flat. And so then if you would go a little bit further, you look at small caps and you look at transportation, they were down almost 1%. So we do see some divergences taking place, and that's why, to me, the broader indices are a lot more important than what just the Dow is doing, because obviously for the Dow to be up 122 points today, there was a few stocks that had a big influence on it. Another thing that would we want to keep a real close attention on is EFA in emerging markets. They're definitely in downtrends. You can see earlier in the year, EFA was just call it 75.5, just say $75 a share, and now it's 67. So you can see that it's over 10% below its highs. You can see it's in a well-defined falling channel, and this is last week. You can see where it tried to break above, and you can see quite a reversal pattern took place in EFA. And a similar thing took place in emerging markets. It's down a larger percentage, same patterns taking place, series of lower highs and lower lows. The counter trend rally over the prior month took it up to try to attempt a breakout last week, only to see a bearish reversal take place as it was kissing the underside of falling resistance at 1. Both did the same thing. Counter trend rallies, tested falling resistance, bearish reversal patterns in these indices that are definitely in downtrends. And so for the S&P to have some success and the Dow and the NASDAQ breaking above these Fibonacci extension levels, I feel they need help from the EFAs and the emerging markets of the world. And so when we see these key resistance tests taking place, reversals and then further weakness, it does move the scale over to lower the likelihood that this is the time we're going to see a breakout of those key Fibonacci extension levels. Just a quick look at, because we just finished the month and a quarter, so while it's fresh, just kind of wanted to look back. This is the QQQ, which is the NASDAQ 100 ETF. This is a monthly chart pattern, and I found it interesting at the 2000 high, where I put this #1 arrow. That is a bearish hangman pattern that took place in the 2000 high. You see one that took place in the 2007 high. You see another one that took place in 2015, before there was, what, a 20% decline in tech. Here was one that took place earlier this year that didn't impact the market a lot. And then last month, we see that a potential monthly hangman took place again in the Qs. So just want to make you aware and empower you that oftentimes when these happen, you start out the month close to a high, it sells off, runs back close to that high, but just can't break out. That is oftentimes where topping patterns take place. So no doubt the trend is still up on the Qs, not a bunch of negative price action has taken place, but this definitely would not be a place where tech would want to see selling follow up on this potential monthly hangman pattern. So we'll spend a little bit of time on some sentiment and valuation charts. One of the things that has an ominous name is the Hindenburg Omen. If you've probably seen it in mentioned of late, because several triggers are going off. If you're interested in more details in the Hindenburg Omen, I would just, as I did today, everybody, you can go Google it. You can look at it on Investopedia. You can look at it on Wikipedia. But I did go and wanted to just kind of highlight what were some of its components. I want to say this, that when Hindenburg omens are triggered, in other words, you get a signal that certain deterioration is taking place. I want to say that not every time through history that's taken place did the market top. But I'll also flip the saying around that at several important market tops, there were Hindenburg omens taking place at those important highs. So this was a piece that I just got off the web. You know, one of the criteria for the Hindenburg Omen is the 10-week moving average of things composite must be rising. The second, the number of stocks making 52-week highs and lows must both exceed 2.2% of total issues traded. The McClellan oscillator, a measure of market breadth based upon advancing and declining, must be negative that day. And finally, 52 new week highs in an exchange must be less than or equal to twice that of the 52-week lows in the exchange. So there's part of the reason I like just paying attention to the Hindenburg Omen is that it is a collective or a combination of a few different indicators. So I'll move on to it. This is from the Felder report from Jesse Felder. Jesse went and looked at what over almost the last 30 years, times when the Hindenburg omens were sending out cautionary messages. And so what I wanted to share is, look, there are times that several messages took place and the market didn't sell off. So this is what I'm wanting to say, that not all times where these go off does it result in ugly markets. But you will see that in the 2000 high, there was a lot of Hindenburg omens taking place. And you can see that here's on the scale is the number of these indicators going off, a number of days, different times that it went off. So you can see in the 2000 high and the 2007 high, the Hindenburg Omen went off roughly 13 different times through these different windows and highs. Again, you can see other times that it went off and the market didn't peak. You can see here was a fairly high series when the market was hitting the 161 fib level and went sideways for 20 months. This was in January of this year. You can see that it was as high as the 2007 and 2000 and 2007 peaks. In other words, quite a few different Hindenburg omens took place earlier this year. What did strike me is there's quite a few that's gone on of late, and actually it's up to 20 Hindenburg omens, 20 different times it's been signaled over the last few weeks, and that's the most in the past 40 years. So again, this doesn't mean that the market has topped or that the market's going to crash, but it does indicate that there is some internal cracks and some negative divergences taking place. That's the main takeaway here, and obviously it doesn't do it this minute. It is sending quite a few omens of late to the marketplace. You know, one of the fun things about the sentiment report and what I've enjoyed for years is, you know, when Sir John Templeton shared with me in the late 90s that he thought stocks at best would be flat for over a decade and a half. A lot of his the criteria that he used to come up with that was sentiment, confidence levels, people being cocky in the form of, hey, I think stocks are going up so much, I'm going to borrow money on I'm going to take out a second mortgage. I'm going to borrow my credit card. You know, I'm going to borrow on my margin account, my brokerage house. So it's been of interest of late that several different confidence studies have come out, and they're reflecting good things, everybody. So don't ever take it that I think high confidence and when people are feeling good is something bad, because it's not true. But we also have to look at the other side of the coin, is that when confidence is really skittish or lack thereof, that's probably one of your best times to buy stocks. And so just this week, one of the oldest confidence surveys from the University of Michigan came out, and you can see that this looks back into the 1960s. So you got a decent time frame looking back over 50 years, and you can see how the confidence levels have vacillated. I remember Sir John Templeton being on Wall Street Week in the early 90s saying people are too pessimistic. I don't think we'll ever see these prices again. And what stocks average like 20% a year for how many years heading up. This was the 2000 peak. There's the 2009 financial crisis. So you see when confidence was low, it was a good time to buy stocks. I got in the business in 1982. People didn't believe in stocks. People were worried about their jobs. I was, just getting into the workforce. Unemployment was high, mortgage rates were high, but it was a good time to buy stocks. And so the bottom line right now, consumer confidence is very high. People are feeling good about things. And in the last 50 years, it's only been higher than current levels in 1998 and 2000. And so from a slow money buy and hold perspective, long-term S&P 500 future returns are very much below average going forward when confidence has been this high in the past. Here's another look at a different consumer comfort survey from Bloomberg, and you can see where we are in the right. This looks back 30 some years. It's at a lofty level. Very few times has it been higher than this. Right before the 87 crash, it was even lower than current levels. There was the level in the 2000 high, and then 2007 high was lower than current levels. But the bottom line is, when confidence is this high, typical 3 to 5 year buy and hold returns in the broad market are definitely below historical averages. Another one I thought was interesting is that the Gallup poll went out and said, hey, everybody, how do you feel about economic issues? Do you have many concerns? And so this is the percentage of people mentioning economic issues as concerns. And so this looks back another really nice time frame, almost 30 years. And so the great buying opportunities come when people are actually concerned. Here was the 2003 low. You can see that 52% of the people were expressing economic concerns at the time. There was the highest reading of any time since the survey was done, which was at the lows in 2009. You can see that 86% of the people were concerned. But important peaks took place when people were expressing very little concern. They were happy with their portfolios, probably a little smitten about their 401k values, how their house was doing, how secure their job seemed. And so you can see in the year 2000 or 1999, only 13% of the people were concerned about economics, and that was right before the market peaked. In 2007, only 16% of the people expressed concerns about economic issues. So these were times to look at harvesting, protect gains, have strategies, know where the exit doors, are in the markets. When it's up high, it's definitely a good time to do your buy and hold, buy your Bahama Mamas, to sit back and just enjoy the ride to the upside. So currently, the Gallup poll right now is at the lowest number. It's at 12, which shows that only 12% of the people are concerned about economic issues. So again, that's good for the marketplace. It means probably job security is high, house values are doing well, your portfolio values are doing well as the market's close to all-time highs. But again, future 3 to 5 year returns are not very high when people are this unconcerned about the marketplace. From Sentiment Trader, this is showing that smart money right now, hedgers have near record short positions. So there's a lot of money betting that the market is going to head south. Each time over the last few years when they did this, the market didn't head south much. The biggest extreme, they did peg the highs earlier this year when the S&P fell, what was it, folks, 8 to 10% in just couple of weeks. And so right now they're betting big again that the market's going to be soft for a while. So the other times, just all that this meant was the market paused for a while, didn't fall apart. This is another chart that I liked, was just looking at credit spreads and trying to look at things the opposite way. And so you can see, folks, when credit spreads were high, that was a good time to do buy and holding, to really put a lot of money out there. You didn't really need to know where the exit strategy was, because it was time to just load up the truck and hang on. And so when credit spreads were high in 2003 and in 2009, those were great times to be a long-term investor as far as loading up on stocks. But you can see on the flip side, when the credit spreads were very small, the credit spreads between government, high quality corporate debt, and junk bonds is what we're looking at from a spread perspective. You can see the spread was very small here in 1999, and it was a time where stocks struggled for the next few years. Here's 2007, and so you can see that the credit spreads right now are one of the lower ends of the spectrum over the last 20 years. And this is even right in here when the S&P was hitting the 161 level, and it traded sideways for 20 months. So you can see that credit spreads are actually a little bit lower than where they were in 2014-15. Another thing that was just put out this month from dshort.com was Crestmont Research, their version of the PE ratio, and looking back clear into 1870. So this is a decent long-term look at valuations. So you can see where the PE ratio stood in 1929. It was 77% above the norm, a couple of standard deviations above the market. In 1965, stocks didn't go anywhere for almost 17 years. You can see where the PE ratio stood. There was 2000 highlighted. There's 2007, and so right now the PE ratio calculated from Crestmont Research would reflect that the way they're looking at PE ratios is now the highest since tying the highest level since 1870. So again, it doesn't mean that the market has to top here whatsoever, because the trend is up, but it does suggest that returns 2, 3, and 5 years out are typically subdued when you have ratios at these levels. This was another look at the American Association of Individual Investor and also Investment Company Institute, where different confidence and cash levels of investors are. And so you can see that right now in the lower part of the chart that all three are very low, and the only time that they were been this low has never taken place, because even in the 2000 top, you can see that the Investment Company Institute reflected that people had more cash back then, which was in the year 2000. But this reflects that that there's not a lot of money's invested in the market, folks. When these cash levels were really high, you'll see that this was close to the 2003 low and 2009 low and the 1990 low. What this reflected when they're up here, folks, is there's a lot of fuel. That just means that the gas tank, the fuel gauge is just stoked as far as availability of monies to still plow into the market. So the takeaway on this chart in the lower right doesn't mean that the market top is here, but it does reflect that the majority of investors' money is already into the market at this time. This is a look at, as we all know, interest rates have gone up. There's the billion, trillion dollar. The huge question, folks, is the long-term bull market in bonds or the bear market in yields, falling yields, is it over? And so there's no doubt that this is the 30-year yield, that it was yielding about 2.2% in 2016, and now it's yielding 3.2. Doesn't sound like a lot, it's just a 1% change, but that is a 50% rally. But the thing that sticks out to me from a pattern and price perspective, we're just back at the top of the trading range. So you'll notice in 2015, rates peaked here. Earlier this year, rates peaked, and so we're testing a very important resistance level at the top of this trading range. And so, what are the likelihoods if it breaks out? Someday the 30-year trend is going to change. From a technical perspective, if it does trade above the top of this range, gets above 3.3, the next significant high comes into play around 4%. So that would be a large percentage if rates could break out above there. But until they do, in my opinion, this still remains heavy resistance. Sorry about that. But it is interesting to look at some sentiment in bonds right now. So this is a look at daily flows from in and out of TLT, which is one of the largest bond ETFs in the States. And you'll notice a couple of days ago was the largest single day redemption of assets in TLT right as yields were pressing up against resistance. So again, a big redemption is taking place as, here's the chart on TLT, as it's testing support. There's no doubt it's been in the downtrend since the summer of 2016. It's had a series of lower highs, everybody, along a series of flat bottoms. So this looks to be a descending triangle, could very well be a head and shoulders top. If TLT would break support here, it would suggest that the next key support comes into play at around 102. So that would be that'd be over a 10% loss. So this is a big test as yields are up against 2015 highs, and on the polar opposite, TLT is testing 2015 lows. So why I think this is so important to the big picture is I love this combo chart, which is the Dow on top from roughly 1912 to present. This is on a monthly basis, overlaid with the yield on the 30-year note since the early 90s. And the only reason, folks, my software does not show, and it's very, very hard to find, yields going back from the early 90s that long of a period of time. So I didn't leave it out on purpose. It's exempt from the most data systems. But the bottom line is the Dow, without a doubt, remains in an upward trend. It's at the top of a 70-year rising channel. Nothing this year has broken that upward trend. It is testing the top of the channel. You can see it tested it in 2000, didn't quite make it there in 2007. But the thing I find intriguing is that yields still remain in a 25-year falling channel. And when yields hit the top of the channel in 2000, that's when yields peaked and the Dow peaked. When yields hit the top of this channel in 2007, that's when yields peaked, as well as the Dow peaking in 07. So we have now a test of a 70-year channel at the top in the Dow and a test of 70 or 25-year falling yields and 2015 highs down here at the bottom at 1. So if the patterns would repeat, an upside breakout in yields would probably be positive for stocks. But from a long-term bullish case, I think what the bulls would not want to see here is yields fall and bonds rally. Because the last time that took place up against these resistance levels, stocks sold off. So I really think that long-term bulls would love to see a yield breakout, not a breakdown. So turning to commodities, which have kind of had a couple of interesting days over the last couple of weeks. This continues to look at the Thomson Reuters equal weight commodity index. This looks back almost 40 years. This is on a monthly basis. The bottom line is this is a rising support line 1 that was hit in 2015. And since this is a monthly chart, we came and hit that rising support 2 months ago, as well as the 2017 lows, and we see a small bearish reversal pattern take place. There's no doubt that the 7-year trend, everybody, since 2007, the trend is down in commodities. There's no doubt over the last few years, it's just stuck in a malaise. It's in this trading range from roughly 450 to 370. And so the long-term message in commodities would be definitely negative if it breaks support here. and it would be wonderfully bullish for commodities if they break out to the upside. And folks, I'm not a commodity bull or bear. I just, why am I oftentimes seem interested in commodities is my interest lies that they've done so poorly for so long and so few people like them. And so when assets are down, 40%, they've been down for 7 years, somewhere along the line, even if it's nothing more than a counter trend rally of a year or two could take place that could, really put some nice gains into our portfolio. So that's why I'm really interested in commodities, primarily because they've just done so poorly. But there's, if you're not into playing some counter trend rallies or trying to catch some knives, I doubt that commodities are that much, of interest to you. But anyway, a 17-year rising support's taken place in commodities, and we've seen a little bit of upside action over the last few weeks. So I want to keep it a close eye on. I've got a buy alert on. This is a DBC. We're not able to trade that prior chart, which is a Thomson Reuters commodity index, but for anybody that's in your brokerage accounts or whatever, you can trade DBC, which is the ETF that tries to track the major commodities index. There's always slippage, folks, in any commodities ETF, so they're great. They're a lot better for short-term trading, folks, than they are for buy and holding. But what interests me is that line one comes into play as the 2009 low, the 2015 highs. So line one, this horizontal line, has been, both support and resistance, which is around the 1839 level, a couple of different times over the last 9 years. And then when you look at the series of falling highs, this is also coming into play as 800-pound resistance at 2. And so if commodities would be successful and break out above dual resistance at 2, you want to be open-minded about being a buyer, because you'd have a breakout of a fairly important magnitude on a monthly chart basis that would be breaking out above 2015 highs and falling resistance. So keep an open mind that if commodities break out here, this would be a good way to play the commodities if you want some broad-based exposure, where you can get a whole series of exposure in the commodities index. Just an update on the silver. This is a silver gold ratio over the last 20 years, excuse me. I've seen some stats lately where gold was down like 6 months in a row. It was very rare. There's no doubt that the metals long-term trends since 2011 highs are lower. They continue to make a series of higher lows or lower highs and lower lows, excuse me. But this that I share each week in the metals report does continue to have my focus that if you're a metals bull, you want to see this ratio going up, and it has been sending quality long-term signals that if you're a long-term buy and holders of metals, this thing that we've shared every week has said, just don't do it. Just be out of the stuff and wait till the opportunity comes. By avoiding a 10-20% decline, even if you put it in a mattress, put it in a tin can, if you have objectives to buy an asset that's down 20%, and even though you're not making any interest, you're gaining purchasing power. So somewhere along the line, if you're open to buying gold, silver, or the miners, these huge declines are treating you very nicely in the forms of increased ability of purchasing power to buy more shares, buy more ounces with the same dollar. So this is a monthly chart, excuse me. Right here, this is last month's price action. You can see that it appears that the ratio is attempting to create a bullish reversal right here at 20-year support levels. So nothing is proven that this doesn't prove that the multi-year downtrend is over. But if there's a chance to get a dead cat rally in the metals, it's got to start somewhere, and you look for little pieces to the puzzle, and this could be one small piece that could be sending a positive message to the metal space. This is a look at silver, everybody, in 3 different time frames. So it's all silver, nothing's changed, but the left is silver monthly, going back into the 70s. This is silver weekly, looking back over the last 3 years, and this is silver daily, just over the last few weeks. So when you look at the big picture, silver could be making a W bottom or a double bottom at the 23% retracement level off the early 90s low of around $4 an ounce and then 2011 high at $50 an ounce. So this 23% level is coming in. You can see that tested support, had a quality rally real quickly, it was a short covering rally, and then we're back down at the 2015 levels are that 23% fib. So you can see this a lot better right here in this chart. So here's your potential, a little closer look on the W bottom, potential of it. And you can see on the weekly relative momentum, it's deeply oversold. So then when you turn to the right chart, as we zoom in then on daily, you can see that of late, silver's attempting to break above short-term falling resistance, and momentum's trying to do the same on a monthly basis. So this has the potential on a long-term basis to be a price zone where silver could be bottoming. Now, it'd be really easy to blow that out of the water, that if it breaks below this 23% fib level in the $14 range, a little bit below that, it'd be really negative, because you got a long-term trend that's down. But what we're looking for here is for aggressive traders trying to look for potential support points and reversals. And what I did do a couple of weeks ago is, there's nothing wrong with if you want to buy physical silver in these conditions, but it's obviously harder to turn it over if it doesn't go well for you. You can obviously you can play silver futures. You can play silver in the form of SLV, so your liquidity keeps increasing. I've taken a small stab at owning SIL, which is the silver miners. So it's really a more aggressive play on silver by owning the silver miners than owning silver itself. And it can go against me in a bigger way as well. But typically the standard deviation on the mining stocks is more than the physical metal itself. So I did share some time back, it hasn't paid off anything big whatsoever, but we do own a position in the silver miners in case silver's fishing for a significant and important low in these areas. One of the things I've been sharing for probably a month, it doesn't matter, a couple of months in the sectors report is a couple of the different assets that are just bringing up the rear, and that happens to be coffee and sugar. And so this is a 10-year chart looking back on coffee, that when coffee was at this falling support line 1, or the lows in 2013 and 2009, some significant rallies took place when support was being tested, and at the top relative momentum was oversold. So you can see in 2009 coffee rallied a couple of 100% in 2 years. Then it fell apart, taking it back down in 2013 to test the 2009 lows again. Then another counter trend rally took place where coffee rallied 150% in a year. And then you can see after it fell apart again, it didn't quite make it down to the 2009 and 2013 lows, but it did rally 50% in 6 months when momentum was oversold again here in 2015. So coffee stunk it up over the last, 24 months. You can see it's lost, 60% of its value, but the decline has taken it down to test potential triple support, which is a support line off the 09, 013 lows at the apex of this potential bullish falling wedge, and this support line coming in. And you can see this is a weekly chart. We're seeing a little pop coming out in coffee here. So if some of you have played coffee futures, it's treating you okay. Coffee had a nice pop today. We own the coffee ETF BJO. For most of you know that the ETFs earlier this year changed symbols, so you can't chart JO anymore. It's just a short-term life on BJO. So this is why, to me, it's most important to look at the futures, and then if you want to trade the ETFs, still use your futures as prices as a decision to look at the ETFs. But as one of the reasons that interested me as well for picking up the coffee was the extreme position by commercial or smart traders. These were the times, this was a position of smart money when coffee rallied 200% in a couple of years. Here was the position of the traders when it rallied 150% in a year. Here were the position of traders when it rallied 50% in 6 months. So you can see right now we have a very crowded trade, that we have a lot of money being bet by the commercial hedgers, the quote unquote the smart money. They've got the biggest bet in the last 10 years that coffee is going to rally. So I do like the condition of coffee doing poorly, long-term supports in play, relative momentum's oversold, and smart money, the commercial hedgers are loading up on coffee. So coffee did have BJO did have a good day today. I think it was up around 6% or 600 basis points. So the upward trend is not proven, but right now it smells like nothing more than a short covering rally. But if these can get going from such oversold levels in these extreme positions, a lot of these people that are short coffee could really push it higher in the form of a short covering rally. And of course, the same thing applies to sugar. So here's a look at sugar going back, 40 years. You can see that sugar spent the majority of the last 30 years inside rising channel 1, creating a series of higher lows and higher highs. So the nasty performance of sugar has been anything but sweet. It's been very sour if you've been long, but the declines over the last couple of years have been substantial to where sugar has lost over 50% of its value, but it's taken it down to test the bottom of this 30-year rising channel, also testing 2015 lows, testing the apex of a bullish falling wedge. And so if sugar would break out at 3, I would suspect that we could see quite a nice counter trend rally take place. And sugar is in a similar situation as far as where commercial or smart money hedgers are. You can see where the hedgers were here when sugar had a really wonderful rally, where the traders were here when sugar rallied for a few years. You can see where the traders were when sugar peaked last year before losing almost 50% of its value. You can see where traders were when sugar peaked in 2011. So commercial hedgers, smart money, have one of the more extreme positions, betting really big that sugar is going to experience a quality rally off current levels. So if the old symbol for sugar from an ETF world was what, SGG, it's SGGB now, is boy. If it continues to show strength and breakout, I'm interested in owning it as well. So speaking of catching a falling knife and some commodities that haven't done well, this is that I sent all of you today. This is agricultural ETF DBA. That it's not done well. It was trading in 2014 almost at the 30 level. We're down below 20. So you know it's a decline at least 35% in value over the last few years. It remains in a obviously this light green falling channel, but it's testing the bottom of this falling channel over the last, this is a weekly chart over the last 4 to 6 weeks. You can see a little bit of an emphasis to try to break out. I did pick up a DBA today as it's attempting to poke its head up here. You can see momentum is at one of the more oversold levels in the last 3 years. Again, this is from a trending perspective. If you're wanting to see established trends, assets above moving averages, DBA wouldn't fit the bill. Leave it alone if that's what it takes for you to be a buyer, and there's nothing wrong with that philosophy. But right here, I'm trying to just pick up some assets that are way out of favor, have done really poorly over the last few years, and see if we can possibly get a dead cat bounce, short-term gains on these assets. So as I get close to finishing, I wanted to finish up that you know, I loaded up when I'm one of the biggest position of the whole year in Apple. on the 2nd of July, when it was attempting to break above what looked like a bull flag in this rising channel. Apple has treated us well. We're now, let's see, bought it 1st of July, August, September, October. Had it roughly 90 days today. And in that 90 days, Apple's up 22%. Apple is testing, this is a weekly chart we're looking at, the highs of a couple of months ago at 2. And so obviously if Apple can break out, I imagine it'll attract even greater buying pressure. I've set the stop. I brought the stop up right below these lows, but imagine in the next day or so, I'm going to bring this stop up even tighter to just below the breakout levels, because with some of the different fractures that we're seeing in the broad market and tech, I really don't want to give up too much of these really nice gains, since it's up, over 20%, in 90 days. So as a reminder, October, a good friend Ryan Dietrich shared that over the last 20 years, of all months, October's had the best performance returns in the calendar, the month. And you can see over the last 10 years that the median return for the S&P is 2.3%. That's a good average return over the last 10 years. So in my opinion, for these type of returns to happen again, Fibonacci extension levels by the Dow, the S&P, and the NASDAQ and the Russell all have to be taken out if these returns have a chance to come true. I do have these charts in a different layout with some buy alerts. On Monday morning, I sent you the stock on Delta Airlines. You can see that it's average gain in the month of October, the last 10 years, is a little over 11%. It looks to have formed a bullish ascending triangle. It's testing the top of that triangle. If it would break out, the measured move would suggest at least a 15% gain should take place. So we're watching that close. I'm going to wait for it to prove itself. So a couple of other stocks look okay, but that's definitely one of the best ones on the list as far as performance and pattern wise. And you can see in the last 10 years that 9 out of the last 10 Octobers, it's pushed to the upside. So I want to thank you all for your membership, hanging with these sideways patterns. I really feel that a lot of things are going to be resolved here fairly shortly. Keep in mind some of these divergences that are taking place. As I shared a few months ago, I've never seen so many markets looking back in my 38 years that were up against extension levels at the same time. And now I have to say we're seeing one of the greater collections, or a larger collection of divergences taking place that we've seen in maybe a couple of years, because we didn't see that many divergences taking place at the January highs. They just seemed to have run into those extension levels and just stopped on a dime. So we believe we've got some very, very interesting times ahead, and we'll continue to keep you updated and empowered on the power of the pattern. Thanks again for your membership, and we'll talk to you next month. Take care, everyone. Thank you.